We hear all of this talk around active is dead within equities. Well, the data doesn't prove that out.
All right, joining me will be Bob Hum, Head of Investment Product and Commercialization at SEI, who currently offers 11 ETFs, over $9 billion in assets. And that lineup has actually grown from about $2.5 billion just 12 months ago. They've seen remarkable growth. And what's interesting to me is that I feel like SEI is flying under the radar a bit because the company overall, we're talking about a shop that oversees some $2.1 trillion in assets in a variety of capacities. But I'm not sure investors and advisors are as familiar with SEI on the ETF side. And so I'll have Bob give us the SEI story and talk about their approach to ETFs and certainly what's been driving that recent growth. And then we'll get into some broader topics as well, particularly around actively managed ETFs. And I should note that prior to SEI, Bob was over at BlackRock for about 9 years, where he was US head of factor, outcome, and alternative ETFs. So he brings a unique perspective on the ETF market. This should be a great conversation. Now, to start this week, I'll be joined by Roxanna Islam, head of sector and industry research at VettaFi, who herself brings a unique perspective on the ETF market. And one of the areas she excels at covering is one that half of you listening will immediately groan at when I tell you what it is. 30% will probably chuckle, and then 20% will applaud. And that's crypto ETFs, which, to be fair, it's been a while since I've gone in depth on these. But if you look here recently, there's been a lot of discussion around whether the so-called crypto winter might be over. And if that's the case, what that means for the crypto ETF category moving forward. And so Roxanna and I are going to dive into what's been going on here with performance. And I'm really just going to have her offer sort of a state of the union on crypto ETFs overall. As always, questions or comments, you can find me on X at Nate Geraci, or you can go to etfprime.com. So let's start this week with VettaFi's Roxanna Islam. Roxanna, welcome back to the podcast. How have you been?
I've been great, Nate. Hope you've been great as well.
So I seriously have not spent much time talking crypto ETFs on this podcast. I have a separate forum for that with the Crypto Prime podcast, as I think you and many listeners are aware. However, crypto ETFs are still an important category in the industry. I was looking this morning, there's around $120 billion here. And so I do want to make sure we properly cover these from time to time on this podcast. And as I alluded to, you are, of course, VettaFi's resident crypto expert. So here we are. Which, by the way, how did you start covering this space to begin with? I'm not sure I ever heard the backstory on that.
Yeah, I mean, I've been interested in crypto for a while. I remember working in sell-side equity research at another firm, Stifel, and cryptos just started becoming popular. And it was just so different from what I did day to day. I remember being on Coinbase, and it was like you had Bitcoin, Ether, and Litecoin, and that's it. It was so small yet so interesting back then. And then once I came to VettaFi, we built a few indexes through our Alarian brand that were crypto equity indexes, and they actually underlied a couple of Invesco ETFs. So I started covering it more officially back then, and that sort of evolved as crypto sort of moved its way into the ETF world with spot Bitcoin ETFs, and it's taken off from there. There's a lot to cover, and it's an area that really interests me personally as well.
Well, I, for one, am glad that you're covering this space. And as you know, it generates a lot of passion. It seems like you have half or more who they throw up their hands anytime they hear crypto. They think it's vaporware. And then you have the other half or less that is highly interested in it. But I think that's changing a little bit. And so let's get into this. And perhaps let's first talk performance, because just over the past week or so, I would say really since Treasury Secretary Scott Bessent said they were stepping up their purchases of longer dated bonds, crypto is on an absolute tear. So Bitcoin is up 25% over, again, about the past week and a half. Ethereum and Solana are up over 30%. Hyperliquid is up nearly 50%. We could go on, but you get the idea. What do you make of this recent spike? I know the Treasury bond buyback announcement is getting a lot of the attention, but that's not the only driver here. So what are you seeing?
Yeah, Nate. Well, I mean, first of all, as you said, the Treasury announcement I think was a huge part of it. Just a little bit of background there. They said they would double their long end bond buybacks from 2 billion to at least 4 billion per operation. So that announcement actually brought longer term yields down, weakened the dollar, and it sort of brought back this debasement trade that we saw a few months ago with Bitcoin and even with gold. And then we had a pretty significant short squeeze on top of that. It created some buying pressure, and that really helped move Bitcoin's price, which actually hit 80,000 a couple of days ago. And then on the regulatory side, there's been a few interesting things happening at the same time. And the regulatory side is interesting because I think it is one of the longer term growth drivers. So it's a little bit stickier than some of these shorter term headlines that you see in the news. So last week, for instance, the president met with crypto and financial industry executives like the Coinbase CEO, Brian Armstrong. They talked about wanting to move the Clarity Act forward. And, we also heard comments from the SEC and CFTC about being eager to do something to move this forward. So even though, the Clarity Act is stalled in the Senate right now, and, chances are it may not even get passed this year, the support it's been receiving has been a tailwind for the industry. And then on top of that, we have ETF flows starting to come back. You alluded to it a little bit earlier in the conversation, but last week, spot Bitcoin ETF saw 2 billion in net inflows. Ether ETF saw almost 900 million. This is just in a week's time, right? So it's particularly interesting because we saw overall outflows for a few weeks now. There's been a lot of pressure on the industry. Even the largest Bitcoin ETF, BlackRock's IBIT, that saw some outflows in the past, which is a little bit interesting because that one tends to be a little bit stickier when it comes to flows. So now that that's coming back and some of this demand in ETFs is coming back, it is suggesting that some of this demand is starting to return.
I think you hit on the three primary drivers there. Obviously, this debasement trade is back in the headlines. I think that's a big driver. You're right on the regulatory side. I keep saying that regardless of what happens with the Clarity Act, the SEC and CFTC have messaged very clearly that they're going to continue to move forward with providing guidance on crypto. And we did see that last week with regulation crypto from the SEC. So I think that's a tailwind. Obviously, the risk there is if you get a new administration here in a couple of years, they could unwind some of that. But I said I think the crypto space is moving so quickly that if people operating in the crypto industry have this guidance and they can move forward, the crypto industry is going to outrun any regulation that ends up or any legislation that ends up getting put in place down the road with Clarity Act or not getting put in place. And then on the ETF flows, I think we know those create sort of a virtuous cycle. As you start getting money into those, that helps the space. The other thing that I've seen is just this narrative that over the past year in this crypto winter we've been in, everybody who has wanted to sell sold. And so the sellers are exhausted. And that gets a little technical, but I do think there might be something to that. Now, mentioning the crypto winter, I think to be fair, and I know longtime listeners of this podcast, my views on looking at short-term performance. I really don't like focusing on just a week or a week and a half of performance like we're talking about here with crypto, because this isn't fast money ETFs or something like this. And the fact is that crypto does remain in a meaningful drawdown going back to last year, even after this huge pop recently. So I'm not going to victory lap a week or two of performance, but there does seem to be a number of positive catalysts right now as we just walk through. Do you see this recent move as sustainable, or what will you be watching most closely here if you had to get out your crystal ball?
Yeah, I mean, I think you're right, Nate. I think it's too early to actually say that this is the end. But I think it could be because we've seen historically Bitcoin has moved in these 4-year cycles. The last bottom was actually around November 2022, which is around 4 years ago. So you could say that we're technically approaching the start of the end of the cycle and the start of the new one. But obviously it is hard to sort of look at that historically. It's a lot different environment now than it was 4 years ago. We have ETFs in the picture; those were just launched. The spot ETFs were just launched in early 2024, so completely different environment now. So it's hard to predict just from that. What I would be watching is regulation, as we talked about earlier. I think that's really what's going to drive crypto forward long term, as opposed to some of these short term headlines that might raise the price for a week or two before bringing it back down. So that regulation, having that in place, is really going to bring some of that long term interest, because it changes how investors really access the space.
If we start diving into crypto ETFs specifically, I'm curious, what would be the story you would tell with these over the past year? Like, there was all this hype when these first got approved, as you were mentioning, nearly 3 years ago with spot Bitcoin ETFs, which I was part of that hype train. But spot Ether ETFs, they've been on the market for over 2 years now. We've had a bunch of altcoin and index-based products launch in what, late summer, early fall of last year. Like, give us your crypto ETF state of the union. What are some of the big takeaways you have as you look at this category overall?
Yeah, it's interesting. I think since last year, the environment obviously has changed a lot. A few months ago, we were sort of in this market where both investors and issuers were sort of willing to try almost anything with crypto. And now it's becoming more selective from all sides. So, Bitcoin ETFs, obviously, there were a few big patterns that I think became more evident over the past few weeks when we saw those depressed prices. We saw assets and flows become increasingly more concentrated in a few different products. So typically that would be the larger, more liquid products like BlackRock's IBIT, and to an extent Fidelity's FBTC, but I would say mostly that's concentrated in IBIT there. And interestingly, there's also some attention over the past few weeks, few months in these lower cost products. So that's products like Morgan Stanley's new Bitcoin ETF, MSBT, which launched just a couple of months ago, actually. And then there's Grayscale's BTC, which is not that new, but it's relatively more new compared to its peers. That one is also one of the more lower cost ETFs. So we sort of saw this barbell where flows were a little bit more successful into some of the bigger products, and then some of the lower cost products. Even now, when you look at the bigger picture, when you look at year to date flows, we're still down 2.5 billion in spot Bitcoin ETFs. And the ones that have significant inflows are some of the ones I mentioned, like IBIT, MSBT, BTC. If you look at Ether ETFs, I think they followed a similar pattern, but obviously flows were a little bit more stressed here. And then another interesting thing that I saw was, we've started seeing some pretty, I would say, significant and interesting closures and filings that have been pulled over the past couple of months. So Rex Osprey closed their staked Ether ETF, ESK, and Hashdex recently closed its Bitcoin ETF, just ticker DeFi. So there have been some closures in some of these major cryptocurrencies like Bitcoin and Ether. And then we saw Grayscale also pull some of its filings for its Cardano, Polkadot, and Hedera ETFs. Obviously, these are smaller tokens, but it's still surprising because Grayscale just has this wide breadth of offering already. But I would say it doesn't mean that demand has really gone away or investors have lost interest. I get that question a lot, but I think it just means demand is starting to concentrate and become a little bit more selective, like I mentioned. Morgan Stanley had still launched their spot ETFs. They launched a low cost Bitcoin, Ether, and Solana ETF recently. Those have been gaining inflows. And then a lot of the altcoins, surprisingly, have had net inflows year to date, even though Bitcoin has had outflows. So I think that's sort of an interesting element there. If you look at some of the more successful spot launches like Solana and XRP, They both have over 400 million in net inflows year to date. And then Hyperliquid, which is a newer one that just launched its spot products in May, that has about 300 million in net inflow. So it's just an interesting dynamic that investors are probably buying these in smaller increments and holding them rather than just liquidating them as they did with their larger Bitcoin positions.
All right. So that's a fantastic overview and several things we can dive into there. Let me ask you this as I think about the crypto ETF State of the Union. You and I would both agree that financial advisors and institutional investors are very important to this space because I don't want to stereotype, but I think retail investors in general are much more comfortable going and obtaining crypto exposure direct versus using the ETF wrapper. Certainly they're using the ETF wrapper, but I think if this space is really going to proliferate, you need financial advisors and institutional investors on board here. And I've been thinking about this. I have this theory, and it might not be all that enlightening. You can tell me. But if you think about the due diligence process for advisors and institutional investors, there's a very high bar to clear there, or at least there should be. And when spot Bitcoin and spot Ether ETFs first launched, as you know, there was initially a lot of skepticism. Even despite the inflows we saw, I think investors were still very skeptical of crypto just in general. And then as time went on, some of these investors became more open to learning about crypto. And then they ultimately made the leap and allocated. And so think about this. They went through this process, advisors and institutional investors, they got comfortable with crypto. And then what happened? They did all this homework, they bought in, and they were met with a 50% plus drawdown, depending upon which crypto asset they allocated to. And they had to answer to clients for that. And my guess is there were some other advisors and institutional investors who were like, see, that's why we didn't dabble in this stuff to begin with. My point, Roxanne, is that I think this drawdown that we've seen over the past year came at the absolute worst time for broader adoption because you either experience massive losses if you allocated here, or if you weren't allocated, it reinforced your belief that this space isn't investable. And so my question for you after that long-winded diatribe is, will it take a similar upturn to get advisors and institutional investors to really pay attention again? Or do you think I'm overblowing all of this?
No, Nate, I think you have it on the nose. I think we do need, obviously another upturn. The extent of that, I'm not completely sure, but I do think we need to see more persistent demand. I'm not sure it necessarily has to get back to some of the highs that we saw, a couple of years ago, but I think we do have to see more of that persistent growth and demand. And, not to be a broken record, but going back to some of the regulatory things I mentioned, I think that's really going to be a huge driver over the next couple of years. Even, besides the Clarity Act, there's been a lot going on regulatory wise. There's been a lot of progress made, a lot of proposals, a lot of things passed. So that's something that's, I think, really going to help push the industry back forward. But I think it's right. I think you're right. It's one of the first times that a lot of investors have experienced a crypto pullback. So I think it's something it's a little bit hard to face, and I think it reinforces, a lot of the things that people like you and I have been saying, that we should have it as a satellite position. It shouldn't be a huge portion of your portfolio, and to do your proper due diligence on it, even if it's something that you're interested in.
Yeah, for people who've been in the crypto space for a long time, the drawdown we've seen over the past year is like a walk in the park, right? It's what you get when you're in crypto. But again, I just feel like there were a lot of advisors who they were hesitant at first, but there was a lot of hype, there was a lot of buzz around this category. They got comfortable and jumped in, and then they've had to stomach this downturn. So I do think it will take a more sustained turnaround than obviously what we've seen over the past week and a half to get people comfortable again. Sort of on that note, one area in crypto ETFs that hasn't really taken off the way I expected it to is crypto index ETFs, or even actively managed products like the one T. Rowe Price rolled out in July, right? Tokens, TKNZ. I think there's another one from 21 shares. And I'm still very bullish on this category longer term. But do you think the general lack of interest in this space is simply performance driven as well. Just what we were saying, and that a lot of these products launched over the past year or so during this crypto winter. And so maybe that is why we haven't seen the demand for these products. Or do you think there are some other factors at play here?
Yeah, I think it's a few different things. I think first of all, there are some investors that are only interested in Bitcoin. They could probably care less about some of these smaller altcoins. And then the performance, obviously, a big part of it. Bitcoin was struggling up until a week ago. So, usually when Bitcoin underperforms, a lot of the other altcoins, they underperform even more. So the performance for some of these multi-token ETFs has been worse than it has been for something that's just compared to something that's just spot Bitcoin. And then if you look at some of these, the fees tend to be a little bit higher than just buying a pure spot Bitcoin product or even another spot altcoin product. So, I think a lot of people say, why, get something that's not performing as well right now for a higher price. And in a lot of these, especially the index market cap weighted products, a lot of them have 70% in Bitcoin. So I think a lot of people are saying, well, that's basically just like owning Bitcoin. What's really the point of that? When you look at the newer active ones that you mentioned, I think it does get a little bit more interesting there, just because crypto is something that's so it can change so quickly. It trades 24/7. So there seems to be a little bit more opportunity here with some of these actively managed products. The T Rowe price product you mentioned is a good example. Tokens. It's interesting because when you look at the breakdown of weightings for that, right now it's about 40% Bitcoin. So a lot different from the 70% Bitcoin you see in some of those index products. And it has around 6% in Hyperliquid, which we talked a little bit about earlier, that has done really well over the past few months. So it's a different perspective than having a market cap weighted ETF with Bitcoin dominance, but flows are still not that significant yet. And I think that just goes back to what we talked about earlier, performance and the majority of interest being in Bitcoin itself.
I think what happens here is if this performance that we're seeing here recently does sustain, and we see a lot of different crypto assets screaming ahead performance wise, I do think investors and advisors will look to these products because they're going to say, I'm not going to try and pick the winners. I'm going to just own everything here. And, we see that obviously with stocks and bonds as well, whether we're talking index based or actively managed, which, by the way, I have to mention. So I think, I do these 5 ETF predictions every year. And I won't get into all of them, but I'm right now 4 for 5. So 4 of those are hitting. The one that hasn't hit yet is that I said the crypto index ETF category would grow to 5 billion, which I think right now is like around 1 billion. So I'm still holding out hope that if we get this performance upturn and we get advisors jumping into this category, I still have an outside chance to get there. But that's the only one that's not looking so good. Hey, just a couple minutes left here. We've talked about Hyperliquid, or at least mentioned it a couple of times. And this is a crypto asset, I think, that has definitely captured the attention of people. And I don't like to focus on short-term performances, I was noting earlier, but since the first Hyperliquid ETF launched back in May, it's up nearly 80%. Any quick comments on Hyperliquid specifically, or the ETFs in this category? Again, I just find this fascinating because it seems to really generate a lot of interest, not only on the crypto side, but on the TradFi side as well.
Yeah, and I think this is proof that there are winners outside of Bitcoin. There are interesting altcoins out there. As you mentioned, there's only 3 of these ETFs, spot ETFs for Hyperliquid. There's a Bitwise product, 21 shares, and there's a Grayscale. And there's about 300 million of net inflows in just those 3 products. And it's a very interesting sort of niche in the crypto world because it's basically a decentralized trading platform, and it does make money from its trading fees, which is primarily from perpetual futures. So it's a clear, easy to understand use case, and there's sort of this clear revenue stream that you can see from it. There's built-in buybacks behind the actual token. So it's an easier valuation story for investors, and I think that's why it's something that's been so interesting, even though it seems like one of the more niche, obscure products. And there's more opportunity that I think could come from there. Right now you can't actually use the Hyperliquid platform in the US. But Trump has made some comments that the CFTC is working on a path to bring that platform into the U.S. So that could potentially generate some more of the trading revenues for Hyperliquid. So overall, I think it's one of the more interesting areas of the crypto world outside of Bitcoin.
Well, and again, with those three ETFs taking in 300 million or so since they launched in May, again, clear indication that if things are going well, advisors and institutional investors and other investors will look outside of Bitcoin and Ether. And to your comments regarding Trump and the CFTC, really what I take away from our conversation here today, Roxanna, when we think about a crypto ETF State of the Union, is you keep mentioning the regulatory environment, the regulatory backdrop. And if they can figure out how to get Hyperliquid, available in the US and there's a regulatory path there, obviously that could be a boon for the platform. But again, it goes back to all of these crypto assets that if you have a clear regulatory framework in place, it's going to set a good positive backdrop moving forward. So I think I agree with you, and that'll certainly be what I watch moving forward. But we'll have to leave it there. Always fun talking crypto and crypto ETFs with you. Thank you for joining me this week.
Yeah, it's been great, Nate. Thanks.
That was Roxanna Islam, head of sector and industry research at VettaFi.
Navigating the ETF market? Get the precise data and analytics that smart investors rely on. Build a stronger portfolio today at etfdb.com.
I'm now joined by Bob Hum, head of investment product and commercialization at SEI, who currently offers 11 ETFs, over $9 billion in assets, including an ETF that just launched a couple of weeks ago, the SEI ANG Research Enhanced U.S. Large Cap ETF, ticker ANGU. Though, as I mentioned at the top, I feel like SEI has flown under the radar a bit on the ETF side, because this is an issuer who has grown from $2.5 billion in assets to over $9 billion just over the past 12 months. And SEI overall, they manage, advise, or administer some $2.1 trillion in assets. So we'll get the story here from Bob, who is joining me from New York. Bob, welcome back to the podcast. It's always great to have you on here.
No, Nate, it's great being back. Different uniform this time with SCI, but excited for the conversation.
Yeah, and as I was thinking about our conversation, I do want to ask you about the switch of uniforms that you had, but I was just alluding to the fact that I feel like despite SEI having such an enormous footprint in financial services and the asset management space, my sense is that some investors and advisors just aren't as familiar with you as one would think. I would say particularly on the ETF side. And so to start, introduce SEI to everyone. Obviously a publicly traded company, but how do you tell the firm's story?
No, it's a great question. And candidly, it's a question we get probably more than we would like. And that's our job, right, is to tell our story, because I would argue, it's interesting. We are probably the largest financial services company in the industry that people don't understand. And we acknowledge that, right? And so maybe just as a quick backdrop of who SCI is, to your point, we are a publicly traded company, over 5,000 employees. We just crossed 13 billion market cap, but really three key businesses. And it's interesting because most folks that I meet in the industry, they'll probably know us from one piece of that, of the SEI's chains, because they've worked in some form or fashion with SEI. But those three key businesses are, number one is fund admin, right? So we're one of the largest fund admins in the industry, over $1.6 trillion being serviced by SEI, and with many of the name brand asset managers that So it's kind of interesting, all the other asset managers in the industry typically are fighting against each other for assets. We're actually partners with many of those asset managers that we also, at times compete with. So the second business is banks, and not banks in the sense that we are a bank, but we're actually the wealth tech platform, or the custodian for many of the largest banks in the U.S. I think we have 9 out of the top 20 in the U.S. We have over $8 trillion running through our wealth platform on that front. And then the third, and the business that I sit in, is asset management. And if we think about asset management, it should be asset and wealth management. And so many folks probably know us from our TAMP business, particularly working with over 6,000 advisors today, $140 billion. But more recently, we've gotten into the advice space. And so with the acquisition of Stratos, the aggregator RIA, based out of Cleveland, Ohio, 40 billion in AUM, 400 advisors, really allows us to not only service many of those advisors, but also be on the same side of those advisors as well. And then specifically within asset management, where I live, we're running about $220 billion across mutual funds, ETFs, SMAs, models, and alternatives. But historically, that has been to service kind of that internal ecosystem at SEI. And so kind of our remit is thinking about, well, what are those capabilities that we can bring outside of the walls of SEI? And kind of that's why I joined about a year ago.
And for you professionally, mentioning that you joined about a year ago, you said you switched uniforms. I did note at the top that you were previously at BlackRock. You were U.S. head of factor, outcome, and alternative ETFs. Maybe talk a little bit about that experience and then your move over to SEI.
Yeah, no, I think I spent 9 years at BlackRock, and those were 9 fantastic years. I think the people that I've worked with, the work that we were able to do, I think was fantastic. And I think one thing that really what drove home to me when I was at BlackRock and I'm bringing to SEI is that I think clients are looking to do more with fewer, right? People no longer want to have 10 different relationships with 10 different providers. I think they're looking for areas where they can consolidate and think about doing more with few key partners. And I think that's what's really interesting about SEI being a diversified both technology and asset management company is that I think we find opportunities to work with folks in unique ways and beyond maybe just our large cap value ETF is better than your large cap value. I think there's other opportunities that we can partner together. And then I'd say the last thing is around scale, right? I think what's incredible about BlackRock is the scale that they bring to their business, and it's something that we have as well at SEI, and something that really was attractive when I joined.
Okay, so let's dive into SEI's ETF presence. The firm has been in the space for over 4 years now. I mentioned the $9+ billion in assets. And we can talk more about that growth in a moment. I mentioned that came from 2.5 billion over the past year, but just high level, Bob, how has the firm attempted a position in the ETF space overall? What will investors find as they look at your lineup?
Yeah, I would say, it's interesting. We are probably in reverse of many asset managers in this space because we started from the institutional side, right? And so we are one of the largest OCIO managers in the space. We've actually been running many of the strategies that we're launching in ETFs for decades now. I think what's unique is that we're now bringing them to the ETF wrapper. And so if we look at the heritage of SEI, I would think of it in twofold. The first is our heritage in quantitative investing, right? So what folks don't know about SEI, well, they don't know a lot about SEI, and we're trying to change that. We were actually one of the early investors in LSV asset management. So LSV is one of I would say, the premier institutional factor managers in this space. We invested with them over, I think, 30 years ago, and are a significant investor there. But that really shaped how we think about asset management or investing, specifically from a factor lens. And so we started our quantitative capabilities about 20 years ago, historically on the institutional side, bringing that to the ETFs, and we can jump into those. And so that's one part of the equation. The second, and it really ties to the partnership aspect that I mentioned earlier, right? Many of the largest asset managers are also partners and clients of ours. I would say one thing that we are unique to is bringing institutional managers to the ETF space. So just as an example, our one of our more recent launches, even though it has a 30-year track record on the institutional mutual fund side, Lend, it actually has many institutional managers that are not available in the ETF wrapper, whether it's Ares, Brigade, Benefit Street, institutional managers now in the liquid side. And so I think you will see more of that, right? How do we bring unique capabilities that maybe weren't available before within the wealth or the ETF market?
And I keep mentioning the growth of the lineup. It's remarkable. The assets in the SEI ETFs have more than tripled over the past 12 months. What have been some of the drivers there as you look at that? Because you don't typically see that type of growth every day.
Yeah, so I would say there's probably three things, and this is and the first is kind of this is uniform across the industry. Some of our flagship products are hitting their key track record anniversaries, right? So I look at our flagship single factor ETFs hit their 3 year marks. No surprise, those are our largest ETFs in our lineup today. Most over $1 billion within our platform. I think the second, and it's probably a little bit unique to SEI, is similar to what I mentioned in reverse of institutional to wealth. We've actually been in reverse to many asset managers from an asset allocation or a models perspective. And so we built, for the last 20 plus years, a robust models franchise. Here, as it's over $50 billion in the US, $80 billion globally. But historically, those models were 100% non-SEI product, or many of those models were non-SEI product. I think what we've learned over the last few years is that many of the capabilities that we have in house, we can bring to the models to reduce cost, bring different exposures to our portfolios that we're not able to get in third party ETFs. And so we've seen some of that within our platform. And then the third is our network. Right? I mentioned at the top, we work with over 6,000 advisors within our TAMP platform. Many of those advisors have been asking us to come into the ETF market because they're maybe currently using an SMA of ours or a mutual fund. And so I think that's been a large driver as well over the past year.
Well, and it always gets into something that I talk about, which is that distribution is king in the ETF space, and you hit on some critical ones there. I love that you mentioned model portfolios and the role that those have played in SEI's growth, because I believe model portfolios are only growing in importance as an ETF distribution channel, especially because you know how competitive the environment is, and that competitive environment only sharpens by the day. Maybe talk just a little bit more about SEI specific model portfolio capabilities, because that's an interesting one to me.
Yeah, sure. So it's interesting. To your point, I think distribution is king, and I think is Eric Balchunas says it's the ETF Thunderdome. I think is the way he calls it. Maybe a little bit dramatic, but it's right. Like there's over 5,000 ETFs today. There's hundreds of issuers now in this market, and so distribution is king. And so I think the way that we've built this organically by building out our model business first has been actually a huge win for us from a broader or a long-term perspective on our ETF platform. Right? I think it's interesting. There's a Morningstar report that shows model assets, and speaking to us not telling our story, we've historically never reported our AUM to that report. We reported for the first time this year. We were number 5 in the industry. And as you can imagine, I got a lot of phone calls about how people can get their ETFs in our model portfolios. But I think that shows to the breadth of what we've built. And so when I think about what makes us unique is that asset allocation advice is actually in our DNA, right? That is not a product line off of a whole menu. We actually started from an advice perspective, whether that's in our OCIO business or our models business globally. And so to me, I think that's kind of a unique aspect of this. We've been doing this for, again, over 20 years now, relative to maybe some of our competitors.
If we set the distribution topic aside, one area I wanted to ask you about was how SEI is viewing the rise of active ETFs, which of course, this has been a hot topic for a while now, but it's not going away. And as you mentioned earlier, SEI is clearly involved in the active ETF space. What do you think about the proliferation of products here? Do you have any strong views around that? And just talk about how SEI is positioning within active ETFs.
Yeah, sure. So I would say active is at the core of what we do, right? And I mentioned earlier, when we're thinking about how do we incorporate some of our investment capabilities into our model portfolios, one of the things that we wanted was actually active factor ETFs, right? Because we wanted things that can iterate over time and isn't an index product that maybe was developed 15 years ago and hasn't changed. I think that was really important to us from an advice perspective. And so that's what we live and breathe. And so, I would say it's interesting. Early days from an active ETF perspective, I would say they were on the periphery, right? The majority of those ETFs, although we talked about the numbers and the growth of that space, it was really a couple categories, particularly on the derivative side, whether it's derivative income or buffer products that were driving that flow. I think what we've seen over the last, let's call it 1 to 2 years, is actually we're seeing active being used across the board, right? I actually looked this morning. Derivative income is still the number one inflowing active ETF category. I think it's taken in over 40 billion this year. But number two category is large cap blend, right? And that's an area where we hear all of this talk around active is dead within equities. Well, the data doesn't prove that out, and I would say we are very much in belief that people are going to be utilizing both index factors and active across their portfolios. And so we are designing products across that spectrum.
Well, and this is a good segue here because you mentioned active factor investing. Let's dive into a couple of SEI ETFs. And two I'll ask you about are right here. They're part of that active factor ETF suite. So the SEI QIM US Large Cap Value Active ETF, ticker SEIV, and then the SEI QIM US Large Cap Momentum Active ETF, ticker SEIM. Maybe talk about how your approach to factors here is different than other options that are available on the market, because we were just talking about the rise of active ETFs. That's not going to change. I do think that makes an investor or advisor's job more challenging just with a proliferation of products. And so maybe talk about how you're differentiated here when you think about that due diligence process from an investor or advisor standpoint.
Yeah, sure. So I would say it probably comes down to three things, right? The first is they are active, right? And I don't, when I say active, I don't mean we are specifically picking securities each one based on our views or talking to the management team, but it's active in the sense that specifically from a factor perspective, every day our portfolio manager are looking at the portfolio and seeing, does the exposure match what we are trying to do? And what I mean by that, just as an example in momentum, if you are a momentum strategy that only rebalances 2 times a year or 4 times a year, in between those rebalances, a lot can change, right? A momentum stock that was trending well last month might not be trending well this month, and we've seen that reversal just over the past month and a half. And so we want to have a finger on the trigger to be able to make changes to the portfolio as the market changes. So I think that's number one. I think the second, and what's unique is, oftentimes we think of, I want to buy a value strategy or a momentum strategy, and that's all they're thinking about, right? Value in particular, well, yes, I want to buy the cheapest companies, but I also want to buy the cheapest companies that also have strong quality characteristics, that also have strong momentum characteristics, while still being a value fund. And particularly, I think that's important when thinking about value traps, right? A company might be cheap for a reason, right? And maybe its earnings are deteriorating along with the price. Maybe it's momentum and the earnings momentum is reducing. And so I think that has allowed us to maybe miss some of those value traps over the last few years and driven extremely strong performance in that case. And then the last thing I think is cost, right? I think, as much as we want to talk about investment process, performance, the management team, at the end of the day, investors care about cost as much as we talk about all of those other things. And, we priced these active products at 15 basis points at the same, very similar level to the index products, but we think you are getting more out of that cost. And so I think that's a differentiator for us.
What are some of the conversations like with clients around allocating to factor-based ETFs? And I'll frame that by saying, are you seeing more tactical implementation, or are you seeing longer term implementation? Because from my perspective, I've always said if you're going to allocate to factor-based ETFs, you have to have the behavioral wherewithal to stick with those over various cycles to actually get the benefit of whatever factor it is that you're pursuing. However, there, as you know, you can go long periods of time where a factor may work or may not work. And so that can be difficult to stick with behaviorally. Can you just talk a little bit more about how you're seeing portfolio implementation with factor-based ETFs?
So I've been in this space. You mentioned my previous background. I've been in this space now for over 10 years, back when we were debating it, calling it smart beta versus dumb beta. It might have been on your podcast when we were doing that. Thankfully, that those days are behind us. But I would say the way that people allocate to factors, and candidly, the education around factors has changed dramatically over that last decade, right? So I would say early days, you really saw a more tactical use case for it, right? I don't, I'm very nervous about the market today. I'm just going to pile into low volatility. Unfortunately, most people, or many investors, did it at the worst time, right? They piled into a low vol strategy after the market corrected. And when the market rebounded, they were upset when, they didn't capture 100% of that upside rebound. And so I think what we've seen, I would say this has probably been over the last 5 years, are two things. One, to your point, I think people are starting to build them into their asset allocation, right? Strategically building these alongside things like market cap weighted core or fundamental active strategies. The example I like to give is, oftentimes we'll talk to an advisor and they have a position in, let's call it the S&P 500 and then the S&P total market, right? Those have 90% holdings overlap. Those are basically 99.9% correlated. I think what we're starting to see today is thinking about, well, instead of using both of those market cap weighted exposures, why don't I use one market cap weighted exposure at the core and then satellite factor-based positioning at the core as well in a more diversified fashion. And then I'd say the second trend that we've seen from an asset allocation perspective is that people still want the tactical or maybe the rotation of factors because they know they are cyclical, right? So depending on where we are in the economic cycle, certain factors will perform better than others. I gave the example of low volatility, but coming out of a rebound, you might want value securities that were most impacted during the drawdown, and that tend to rebound the most on the upside. And so I think many advisors have realized that's something that they might want to outsource. And so you're seeing a rise in strategies or factor-based strategies that have the ability to tactically or tilt the portfolio based on different signals, whether that's momentum of the different factors, valuations of the factors, or the economic regime we're in. And so that's why we actually recently launched SEUS as another product that's able to tactically rotate across the factors, and a strategy we were running institutionally for quite some time.
Just a few minutes left here. I did want to ask you about one other ETF, and it's the one that I mentioned at the top, which is also your most recent launch from just a couple of weeks ago. So the SEI ANG Research Enhanced U.S. Large Cap ETF, ticker ANGU, ANGU. This one is actually index based. Do you want to offer a quick snapshot of that?
Yeah, sure. So I think at the core, there's a few things. One, the name is not accident. People are wondering, what does Ang mean? It is because it was developed by Andrew Ang with stocks on the index side. And so for those that don't know Andrew Ang, he was actually previously the head of factor investing at BlackRock, but also a very well-known academic in this space. Actually wrote one of the seminal books that is now used at most or many universities today. And so, when we were set out on this journey on the index side, and as I mentioned, we think investors are going to look at index factors and alpha-based strategies when building their portfolios. We wanted to think about, are there better ways to potentially develop low-cost index-based exposure? And so that was the goal. How do we keep this low tracking relative to the broad market? Because at the core, people still want market returns. But are there ways for small areas of improvement, whether that's looking at factors, again, whether that's tilting based on the economic regime? We package that into an index-based product with Andrew and stocks, and now have that ANGU, to your point, at a very low cost at 10 basis points. And so that was something that we were looking candidly to develop for ourselves, for our model capabilities. It's something that our investment teams were looking for. but we think it's something that is applicable to many investors that are questioning, whether it's the concentration risk within market cap weighted indices or just the ability to potentially outperform those broad-based market exposures.
Before I let you go here, you've done an excellent job of walking through SEI's approach to the ETF market. Hopefully, a lot more people will now be familiar with SEI's ETFs. Can you tell us anything about the game plan moving forward? I assume continue to expand, continue leveraging model portfolios, but what might that look like for SEI moving forward?
Yeah, I would say we think about it in three ways. The three areas that we are getting the most demand from our advisors. Number one, and we've hit on it today, is ETFs. And so that will be a huge area of growth for us. I think a year ago we had 7 ETFs, 2.5 billion to your point. We're at 11 ETFs, 9 billion. We're hopeful that we can get that by the end of next year to over 20 ETFs and $20 billion in assets. And I think we will continue to leverage our strengths on factor-based investing and leverage our partnerships that we have across the industry to deliver that. I think the second, and this could be both in the ETF space, but also just beyond that, is private markets. We think many advisors are continuing to think about how do we get more private market exposure in their portfolios. We recently announced a partnership with Carlyle on the interval fund side, but are there opportunities to bring more private market type exposures to the ETF land? Lend is a good example that is both high yield bonds, but also alternative credit, right? And more illiquid exposures in a portfolio. We think that's an area of opportunity. And the third is models, right? I think more and more advisors, and this is how we built our business, they are continuing to look for scale in their business. They're looking for differentiated exposures at the model level. That is an area that, whether it's tax management, whether that's new types of models, whether there's partnerships, it's an area that we will continue to innovate and lead, given kind of our strength of our business.
Well, Bob, I always enjoy connecting. Congratulations on all the success you're having with SEI's ETF lineup. Certainly wish you the best moving forward. Hopefully next time you're on here, you're over that 20 billion in asset mark that you mentioned. Would be a nice milestone. But thank you for joining me.
Appreciate you having me.
That was Bob Hum, Head of Investment Product and Commercialization at SEI. That'll do it for this week's ETF Prime. Build your ETF expertise and separate yourself from your peers by registering for the ETF Institute Certified ETF Advisor Program. You can learn more at cetf.org. Next week, I'll be joined by Maria Rani, Senior Director, Equities Product Manager at New York Life Investments. So we'll be spotlighting their $2+ billion international equity currency neutral ETF, which is seeing a lot of interest this year. And then I'll also be joined by Sandra Testani, Head of Global ETF Product and Strategy at American Century. So we'll get into their ETF lineup to include the Avantis ETFs. We'll also talk markets, some ETF trends. This will be a wide-ranging conversation with a fantastic industry resource. Until then, have a great week, everyone.
ETF Prime is hosted by Nate Geraci, president of OTR Media, LLC. Nate is also president of investment advisory firm Nova Diaz Wealth Management. While OTR Media and Nova Diaz are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by Nova Diaz. This program is for informational purposes only and does not constitute investment advice. Investing in ETFs involves risk, including possible loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Some guests appearing on this program may also be financial sponsors of ETF Prime. OTR Media and Nova Diaz are not affiliated with VettaFi or any of its affiliates. VettaFi's participation in this program should not be construed as an endorsement or an indication by VettaFi of the value of any OTR Media or Nova Diaz product or service. Visit etfprime.com for more information.